So have you ever wondered why the smart money always seems to generate higher investment returns and more consistently than retail investors? Now, fear, greed, FOMO, these are all the emotional traps that we all fall into, allowing these weaknesses to be exploited and to be used against us. Now, that leaves you and it keeps you several steps behind. So in this video, I'm going to explain how you can generate more consistent returns by focusing on positive habits that are going to allow you to compete on a level playing field with the smart money. So welcome back to the Personal Finance Crew. And if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. So every year, countless retail investors enter the stock market with these dreams of financial independence, only to find themselves consistently underperforming the market and lagging well behind the smart money or the institutional investors. And this performance gap isn't just about a lack of financial resources or even intelligence for that matter, but because investing is shaped by human emotions, and these are very real. And this is combined with a very long list of psychological biases thrown into the mix. So understanding why this happens is the first step to closing this gap and becoming a smarter investor with consistently better and higher investment returns. Now, fear and greed are the most powerful drivers of market behavior. And as retail investors, we are especially susceptible to these emotions. So when markets start to surge, FOMO kicks in and it pushes us to buy overhyped stocks or to get involved with market bubbles at distorted or even overstretched prices. Now, conversely, during downturns, the fear starts to take over and that leads to panic selling, often at rock bottom prices. Now, this buy high, sell low retail investor cycle is the polar opposite of smart investing. And this cycle is a proven method to massively underperform the market and to actually lose money over time. Now, to give you a greater understanding of the range of emotions that we all go through, let's have a quick look at this chart on screen. So initially, we see markets rising. We are more optimistic naturally, and we may consider investing even more of our hard-earned money. Now, as markets continue to rise, we get into a state of euphoria. And I've heard of people borrowing on credit cards so they can invest even more money in the stock market. Now, clearly, nothing is going to go up in a straight line forever. So as markets start to reverse and they start to correct and they start to fall in value, we're overtaken by fear. And finally, we capitulate and surrender. However, markets don't continue to fall forever either. And I've lost count of the times that clients have called me to say, if this carries on, I'm going to lose all my retirement savings. So I may as well take it all out now and put it into a bank account. Now, smart money, on the other hand, they feed on our emotions like vultures. They know exactly when we're going to feel the most financial pain and when we're going to decide to take money off the table. And that's exactly when they strike and when they increase their investments. Now, Warren Buffett once very famously said, the stock market is a mechanism to transfer wealth from the impatient to the patient. But he also said, be fearful when others are greedy and to be greedy when others are fearful. Now, retail investors tend to concentrate heavily on a few trending stocks, hoping for outsized returns. Now, this can work in your favor if you've got the courage of your convictions for the long term. However, this can leave you very vulnerable to catastrophic losses if these bets go wrong. Now, a classic and well-known example of this is the retail investor rush into buying tech stocks during the dot-com bubble of the late 90s, or the current crypto frenzy, and of course the recent launch of the Trump and the Melania meme coins. Now, smart money, however, they prefer diversification across asset classes, across sectors, across countries, and this reduces the overall risk whilst maintaining the potential for steady returns. Now, retail investors often misunderstand the importance of diversification, viewing it as settling for mediocrity or being average, where in reality, this is the cornerstone of long-term returns. Now, proper diversification has been called the only free lunch in investing. Retail investors also try to time the market, which is trying to predict the perfect moments to buy and to sell. And this is a common pitfall and it's a fool's errand. And this strategy is going to require luck and consistent accuracy And even the seasoned professionals can't get this right all the time. Now, we all know from investing or from a professional point of view that it's not timing the market that matters, it's time in the market that matters. So if you're finding value in this video about how to help you get more consistent returns and allow you to compete with the smart money, then please give it a like and subscribe to the channel, where we aim to continue to build this financial community all the way throughout 2025. So we're going to have a very close look and a detailed look at the 20-year performance of the retail investor when compared to the S&P 500. Now you can see here that the S&P 500 has generated annual returns of 7.5%. Now more recent information is going to show even higher average stock market returns, but the retail investor underperformance is real, remains in place, and it's even greater than ever. Now, in fact, if you take a closer look at our thumbnail for this video, you're going to see that the S&P performance for 2024 was about 25%, but the retail investor just managed 9.8%. Now, having another look at the S&P 500 chart, you can also see that the 60-40 portfolio generated an average annual return of almost 6.5%. And we can argue whether this portfolio is still suitable in today's economic environment in the comments, so let me know what you think. But here's the really important bit. Have a look at the average annual performance of the retail investor, and that is just 2.9%. Let that sink in for a minute. So why is there such a significant and consistent difference between the smart money and the retail investor? Well, retail investors are more likely to chase market highs and bail out during the market downturns. This is going to lock in losses instead of waiting for the recovery of the stock market instead. Now, financial markets have always recovered, but we just don't know how long it's going to take to recover. And that's why we all need to be extremely patient. And that's a quality that many retail investors just don't have. And meanwhile, the smart money, they rely on long-term strategies which avoid this emotional whiplash of market volatility. Now, retail investors often struggle with discipline, and that can lead to overtrading as well. And this means you're constantly buying and selling in response to news, social media trends, gut feelings, recommendation from friends or the man down the pub, and these just rack up transaction costs and taxes, and that eats into your personal profits as well. Now, overtrading often reflects a lack of conviction as well as an investment plan, and that can result in very poorly performing portfolios over the long term. Whereas the smart money, they maintain strict financial discipline at all times. And the smart money also develops and sticks to their investment plan, and they never react impulsively, and they always stick to their long-term convictions as well. Now, retail investors can also fall prey to high fees and charges associated with actively managed funds. Now, as you can see on screen, 94% of active managers have underperformed the S&P 500 over the last 20 years. And that percentage has not improved in recent years, and that doesn't matter whether the active manager is in the UK or even in the US. Now, of course, that's not to say that there isn't a place for active management if this reflects your investment approach, but the consistent long-term outperformance is difficult to find. Now, in previous videos, we've talked about high fees and charges and how they can significantly erode your returns over time. In fact, even a 1% annual fee can reduce an investment portfolio's value by 28% over a 30-year period. Now, the smart money, they tend to favor low-cost index funds for about 80% of their portfolio, with about a 20% tactical overlay of active management, but only where they see real value being created over the long term. Now, this results in a compounding advantage for the smart money over retail investors, as the retail investors don't tend to scrutinize their overall fees and charges. Now, retail investors can also be at a bit of a disadvantage when it comes to accessing information as well. Now, while the smart money does have access to some advanced research, the retail investors often rely on publicly available information, or even worse, just social media and hype in general. Now, who can remember the hype around GameStop and the rush to buy AMC shares a few years ago? And we also have the rise of platforms, retail platforms like Wall Street Bets and Robinhood. And this has amplified this issue, with retail traders frequently chasing hot tips or speculative plays without really fully understanding the risks that are involved for their portfolio. Now, this reliance on questionable information leads to very poor decision making, as retail investors often get caught in this herd mentality of everyone's doing it, so why shouldn't I? Smart money, on the other hand, they conduct rigorous due diligence, and they often use retail traders' predictable behavior always to their advantage. Now, if we look towards behavioral finance, this can highlight several biases that disproportionately affect all the retail investors. Now, one of those is loss aversion, and that's where retail investors tend to fear losses more than they value their gains. And this leads to irrational decisions such as holding on to losing investments in the hope of a rebound, or even selling winners too quickly just to lock in very small gains. Now, another bias that we need to try and look to overcome is herd mentality that I mentioned earlier in the video. This is where we basically follow the crowd, and this often leads to chasing overvalued assets or panic selling during market downturns. And another bias that we need to be aware of is something called anchoring. And this is where retail investors often fixate on a specific reference point, such as a stock's recent peak price, or as the 52-week high, for example, or even who's a top performing fund in 2024. Now, smart money, they are detached from these emotional biases, and they are better equipped to avoid these emotional traps, and that gives them a consistent edge over retail investors. On top of all that, retail investors have a notoriously short-term mindset. They're tempted to chase quick profits, and they are frequently checking their portfolio performance and reacting to every market fluctuation. From experience, I know that not only increases stress, but it also leads to very poor and inconsistent decisions. Whereas smart money, they take a long-term view, a long-term mindset. They understand that building wealth is done over decades and not days. So some of the reasons why the smart money consistently beats retail investors just boils down to a combination of emotional discipline, strategic planning, and of course, a long-term mindset. Now, retail investors, they face a different set of challenges, such as fear, greed, and of course, the famous FOMO. They also feel victim to behavioral biases as well, over trading, overconfidence, a lack of control over high fees and charges as well. But all hope is not lost. We can all narrow this gap by adopting these following simple strategies, such as controlling our emotions, diversify wisely, avoid trying to time the market consistently. We need to look at reducing fees where we can. We also need to stay informed by staying tuned to this channel, of course, and of course, think long term. Now, getting better, higher and more consistent long-term returns is critical, as we don't all want to be reliant on the support from the government when we retire, and they can change their policies at very short notice. Now, I've linked a further 2 videos in this series about a means-tested triple lock for our state pension, which the newly appointed pension minister has called a silly system. And I'm also going to include our recession in 2025 video, as economic conditions has continued to get worse since that was recorded, with a spike in unemployment, unsurprisingly, to 4.4%, which is the highest in the last 6 months, with 27,000 less job vacancies, and that's the 30th consecutive monthly fall. Thank you all for watching to the very, very end. Thank you for your time, for your patience as always, and we'll see you all again next week.